righty. Awesome, awesome. So I tell you, the gentleman that's coming before you today is none other than Mr. Douglas Eze. He has more than 20 plus years in the financial services industry. And as I said, the information that he is going to share is absolutely life-changing. Most of you will not believe it because you've never heard of it, and that's by design. So I encourage you right now to listen with everything you have, because he's going to show you how you can create your own bank. What? Yeah, I said it, your own bank. Please help me bring to the stage none other than my friend, Mr. Douglas Eze. Welcome, Douglas. Let's see, we can't hear you. Let me see, make sure my volume is right. Okay.
Yeah, you hear me? Sorry about that. How are you?
I got you. We're doing great. You want me to make you a host, or you going?
Yeah,
sure. You
sure.
can go off the dome. You just got it like that. So let me make you
Definitely.
a host. All right. Excellent.
Awesome. Make sure I grab it.
You got it?
Now,
Too.
Yes. Awesome. Let me make this bigger actually on my side, because I try to get it on there first to make it zoom, man. You gotta always know how to use this Zoom stuff.
Yeah, you using it too.
I use it all the time. Awesome. But let's go ahead, and I know you had some questions for me and all that, but I just want to say, again, thank you so much for doing this. It's so important that we educate our folks on the importance of financial literacy and financial education, because at the end of the day, when it's all said and done, it's all about being in control of your money. And if you're not in control of your money and somebody else is in control of your money, then you can never acquire the amount of wealth that you're looking to acquire. And I'll say this, one thing that I tell everyone, I say, the industries, the media, the government, the banks, all these industries are always looking to do what? Use other people's money, right? So in them doing that, they always, whose money are they looking to use? Well, you, the consumer, your money. They're looking to use your money. So if you think about every dollar you earn from your paycheck, every time you earn a dollar, 40 cents of that dollar immediately goes to taxes. And when I say that, I'm talking about not just your income tax that comes out of your paycheck, but I'm also talking about the tax you pay when you go to the grocery store, the tax you pay when you go to the mall to buy clothes, the tax you pay when you buy gas for your car to drive to work, the tax you pay on your property at home. Says on your paycheck, now you gotta pay taxes again on living your life. So that's 40 cents of your dollar. Then when we look at credit card and interest rate that we pay on student loans, credit card, mortgages, what's the other thing? Car payment, 34 cents of every dollar you earn goes to those banks. 34 cents. So between the banks and the government, that's 74% of your income that is gone automatically. And then you're left with 23% to live out the rest of your life, to live your lifestyle, to enjoy yourself, to do the things that you love to do. And then at the end, only 3% goes towards your savings, your income. So using my screen, just to kind of share that story and see how your money is being controlled. And this, by the way, this screen the stuff you're seeing on the screen right now is what I call your personal economic model, which basically means this, a lot of people have this in their financial bucket. Everyone has this. The only problem is only a few people that understand it, they use it to cultivate and build wealth for themselves. The ones that do not understand it live paycheck to paycheck. So we go out and we make money. We go out, we go make our income, right? From our full-time jobs, we make income, the money comes in. So I'm just going to keep it very simple so you all can paint a picture in your mind and see what's going on with your income when it comes in. So if you make $100,000 income, just using that number, all right? And I'm going to actually even make it even come to life for you, so you could see how $100,000, even 50,000, you know, what that money looks like and how quickly it goes. Because we don't think about certain things until it happens. So let me bring up the screen here, and we'll talk about it. So you make $100,000 in income, the money comes in. The first thing that most people do is, you know what, I got to save in my 401k because I need to save for retirement. So they take 10, let's just say the guy wants to put away $10,000. So $10,000 of that money immediately goes into your 401k tank. This is your, I call it your garage, your 401k garage. But remember, this tank also has risk tied to it, right? Because you could make a lot of money in the garage, a lot of money. You could make money because it's growing every day. And if you notice, it's going in a tank, just like water, right? You're pouring water in a tank. You got to keep pouring water until the tank is filled up. Same thing with money. You got to keep pouring money inside your savings tank until it fills up, which is the goal, to fill it up. But unfortunately, what happens? Well, because it's in the market, you can also lose money, you know, and so it goes up and down, right? That's why it's risk involved. Now, at the same time, the government is also monitoring that account, because every money you put in, remember, you made that 100K and it went straight in here and you didn't pay taxes on that money. So the government says, hey, you know, you don't have to pay taxes right now. You pay it in the future. So you're postponing that. So what happens? They control this valve. They control that stuff. They determine how much taxes you have to pay depending on your age when you retire, right? When you retire and how much income you have at that time. So depending on how much income you want to live with. Now, some people might say to you, well, when you retire, you'll be on a lower tax bracket. Well, is that true? How are you sure you're going to be on a lower tax bracket? How much income do you want to live with? Because the last time I checked, a person on a lower tax bracket is somebody that does what? Has low income. If you make low income, yeah, you'll be on a lower tax bracket. But if you're making high income, guess what? You're going to pay high taxes. But that's one conversation. Then we're going to continue, and this person says, you know what? I'm going to live off of $90,000. That's the rest of the money. Well, it flows into this tank, so that's what comes out from the tank. So you're already saving 10 grand. You didn't pay taxes on the 10, so you're saving that. So the taxes on 90,000. So let's assume this person here, before he touches the money, let's say the government says, you know what, we're going to take $20,000 based on your tax bracket. So we're going to use 20K. 20K is gone to the government. So now this guy is left with $70,000 to enjoy his life, to live his lifestyle. So what happens? He says, okay, I got to take care of my mortgage. I got to take care of my utilities, pay for car, pay for travel, pay for food, before you know it, the money is gone. It takes a lot of effort and a lot of energy to really save money towards your future, your financial future, your future lifestyle, to put money in this safe tank. So if you look at the safe tank, it has a cap on it. The reason there's a cap here is because any money that comes into this tank is meant to be safe and secure. That means you can let the money sit there and grow, but you can't lose it. It's not tied to the market. There's no risk involved. But the only time we lose money is what? When your cousin calls you and say, hey, you know, can you loan me some money? And you look in your safe tank, oh, I got it. How much you want? I want 5 grand. You take and give it to them. Emergencies happen, you take and give it. It's like a put and take savings account. The money is gone, drained out. Now you have to force yourself to save again. So what I'm going to also talk about is how you pay yourself back. Whenever you pay cash for something, I'm going to show you how to do it in a more efficient manner, where you don't lose the money in this tank. You let it sit there, continue to earn compounding interest, and then you leverage it. See, the key is using other people's money to grow wealth, because the banks understand the power of leveraging money. They understand that. So what they always do is this. What do? They come in and they loan you money, and they use your income, your future income, as collateral to loan you money. And that's something, see, most of us don't ever think that. But when you look at when you go apply for a bank loan, right? You go into the bank and you apply for a loan. What do? Immediately the bank says, well, we're going to loan you the money, but let's see how much money you make. How much do you make a year? And they use your income as collateral. And then they come back and then they check your credit, and then they give you the loan. They put the collateral on there. Now, if you want to buy a house, what does the bank do? Immediately, they'll loan you the money, to buy the house. So if this mortgage is this is your mortgage, you want to buy this property here, you know, right now all the equities in there, this property is worth $200,000, and you want to pay $100,000, you go to the bank and you borrow money from the bank, and they say, well, we'll loan you the money against the property. So now what does the bank do? They come in and they give you a loan against that property, and then they transfer the equity from, the collateral from your income to the house. We won't get back to this. Now, just to come here real quick and talk about the importance of making sure that you control your money. So I'm going to talk about compounding interest and amortized interest, because so many times we don't understand the difference. See, amortized interest is when you're paying somebody back. Interest rate can do two things. It could either be working for you or working for somebody else. So most people that don't understand interest rate, they allow interest rate to work against them instead of working for them. So I'll give you a simple example. Let's assume we're going to start with compounding interest first. Let's say you have $30,000, just using that as an example, all right? $30,000 sitting in your account. Now, I know you don't have an account that's paying 5% interest, because there's no such account, right? In the traditional world, you know, in the world that we know of, right? There's no account. There's no bank account that you could go and get a 5% rate of return in what the media has shown us. Because a lot of us do what? We listen to the media, right? That's where most people get their information, from the media. Because remember what I said earlier? I said the banks, the media, and the government, all three of them work hand in hand to get your money away from you fast. So if you're listening to the media, what do they tell you to put money in? Especially when you listen to some other financial experts, right? They say, you know what? You need to put your $30,000 in a traditional savings account where you're earning 0.1% interest rate. So when we look at that, I'll use one that pays 0.25%. You go on their website, you see that. So 0.25%, that's $377 in 5 years. It takes you 5 years to make $377. No wonder so many people are so pissed off and upset. So this same person, you go to the bank and you already know you're only making $377. If we bring this to a year, just look at that. In 1 year, only $75, right? And you're looking at your account, you're like, man, I only made this. This is crazy. You get upset. But this is traditional bank that you are familiar with, the brick and mortar, where you have the bank manager, they sit down and they greet you and they talk to you, right? So check this out. But another thing that most people don't think about is the amount of taxes you got to pay. Because remember, this is now earned income. So at the end of the year, you got to pay taxes on this interest you just earned. That's crazy, but we never think about that. We just look at our balance in our statement. Now, let's say this same guy decides, you know what, I want to buy a car. And he goes to his the same bank now. And let's say the car costs $15,000. He wants to buy a $15,000 car. All right. He goes to the bank, and the bank says, well, we're going to charge you interest rate of 5% and finance it for 5 years. He says, okay, I'll do it for 5 years. And the bank said, pay us $283 a month. Immediately, the guy looks at the statement. He looks at the situation. He says, $283. I really don't want any car note. You know, I don't want a car note because I'm going to end up paying them interest in 5 years. And let's look at the amount of interest you pay. The interest is only $1,984. But you know what? We don't blame this guy, because he's going to say, you know what? I'm just going to pay cash for it. I'm going to go ahead and pay cash for this car because I don't want to pay this interest. But again, look at the interest, $1,984 over 5 years, right? But he says, well, I'm just going to go ahead and pay cash. So I'm going to go in my $30,000 and deplete it to $15,000 and drain the tank. Remember that tank I showed you earlier? You drained it to 15 grand because you want to pay cash because you don't want to pay this interest. So when you do that, in the same 5 year period, now your interest earned is $189. But in your mind, you're like, I did a great thing. I paid cash for my car. And you're happy because you didn't have to worry about it. But what you didn't also realize is the fact that the bank actually took your 50, because the bank didn't print the money. They took your money from your account, and that's what they did here. They loaned it to you here. That's what they did. They made the money. They're charging you 5% interest on the car loan, and that's why you got pissed off and paid yourself and went in and took money from your hard-earned dollars, because it took you a while to save this $30,000. And you went and you drained it to 15 grand. Now you only have control of 15,000 because you just gave up $15,000 to the car company, and because you didn't want to pay interest. So now you don't have interest to pay to the bank because you pay cash, but you also lost interest on the balance of the 30 grand. Because if you had let your $30,000 here, your account would have been 377. But see, this is what we talk about. When I talk about creating your own bank, you know, so many people don't understand what I mean by that. What I'm talking about is using what we call cash value life insurance as a place to park money and then leverage that money to do the things that you want to do. I'll give you an example of what I mean. First off, there's different types of cash value life insurance, but the two most popular ones today is what they call a whole life insurance and an index universal life insurance. With a whole life insurance, this is how some companies have it, where they pay 4% return. Now, it's not going to be dollar for dollar, but we're going to just keep it simple, just for the sake of this meeting. There's loads of information that you got to understand, but just to keep it simple for now. With a casual life insurance, you're in a 4% rate of return. With the same example, in 5 years, that's $6,630 that you just earn in interest on the money. Why not leave your money there? Go take a loan from your traditional bank for 15 grand, and guess what? The monthly payment is $283 a month. At the end of 5 years, looking at the same number, because the reason I'm showing you this is just to kind of get you thinking about compounding interest, how powerful compounding interest is over amortized interest. When you look at compounding interest, the money compounds every year. Amortized interest, look at the difference. 283, you only pay 1,094. 5 year, and this is a 4% rate of return against a 5% rate of return. I mean, a 5% interest. 4%, 5. You're making less, but your money is bigger. Here, they're charging you more, you pay less. You always have to pay somebody for the benefit of using their money. Always remember that. There's no such thing as free money. You always got to pay someone. Either you're paying somebody to use their money, or you're going to give up the money that you're going to use for yourself. So that's what I call self-financing. When you pay cash for something, you're self-financing. See, we don't think about it that way. We always think when we pay cash, that we're paying cash for the money that we're using. So when I bring this guy back up, this is just saying and showing you how self-financing works. See, you finance everything you buy. You either pay interest, you know, to borrow money, or you give up the ability to earn interest. See, you save interest by paying cash, but you also lose the interest you would have earned had you not drained the tank. If you didn't take all the money out of the tank, imagine how much money you could have made in that tank. See, this is your full money right here. That's your $30,000 sitting here. But when you went and took it all out, now you don't have no more money. See, that's what we call that. Now, again, using the same scenario I just showed earlier, now to bring the picture right in forefront so you kind of start thinking differently. See, this illustration is going to help you understand that. See, every time we do stuff, this is what happens. You have the $30,000 saved in your tank. You already have the money saved. Just think about how long did it take you to save this money. Now you need to make a purchase for that same amount. We come in, we charge 5% interest. Then there's this word called opportunity cost. And then what is that? For every dollar you earn, imagine how much that dollar, if you save that dollar instead of spending it, how much will be worth in the future. So in this example, we're using a 5% opportunity cost rate. So again, we're going to look at a 60-month example. and see what happens in 60 months. So like in this case, this guy says, you know what? I'm just going to go ahead and finance this situation. I'm going to finance it. And he finances it. The bank says, pay us $566 a month. Your money earns interest. You use other people's money, OPM, paying them interest. Remember what I said? If I'm going to borrow money from somebody, I got to pay that person interest for borrowing their money from them. So, and I want to keep my money and do nothing with my money. Let my money continue to make 5% rate of return. And the key is I maintain control. The key to wealth building is own nothing, control everything. Control is the key. When you control your money, you win. And you want to control your money in a place where no matter what goes on in the world, it doesn't affect your money. All right? So again, looking at that situation, we come in, we borrow the money, we start paying back $566 every month to the bank, paying them back every month. In the meantime, my $30,000 is also growing every year, growing, making me money, growing. At the end of 5 years, because that's 60 months financing, I paid back the bank, I paid them back interest, $3,968. But I made profit, $8,501. So if we do the net on that, how much did I really make? Well, I really made $4,533 because the bank took out $3,968 because I paid them that amount. But the bank themselves, they lost $4,533. But now, do they really lose? Because the bank is always doing what? Making money. Because the money doesn't just sit in your bank account looking at them. What the money is doing, the bank is using the money to go make more money. But I only paid them $3,968, but I made $8,501. So in this case here, I won this situation. I won. I have more money, and I still have control of my $38,000. I didn't lose control of my money. Now, the second example is when the person says, you know what? What if I give them extra money? Let me pay extra $200 so I could pay off this car quickly. I want to pay less interest. Well, yes, you pay less interest, but you still paid interest. So making extra contribution to the money doesn't really help you that much other than you pay less interest. In your mind, you're thinking, well, I only paid less interest to the bank. I'm good. Well, this $200, why didn't you just add it here to your $38,000? Imagine this. If you were able to take that $200 and contribute it, instead of giving it to the bank, watch what happens in that same time frame. We use the 5% example in this. Look at what happened. Now look at your money. Instead of making just $8,000 in interest, you walked away with $10,000 in interest that you earned. Now your final balance is $52,102 because you took that $200 that you could have been giving to the bank. You start doing it, put it in your own savings account. And I'm not talking about your savings account at your local bank. I'm talking about an alternative savings account where we use cash value life insurance for that alternative. Why is that? Why do we want to use life insurance? Well, because we want to do two things. We want to accomplish two things. The first thing is to make sure that our family is protected just in case death happens, because we are all going to die. Nobody's going to leave this world alive, right? On your birth certificate, there's no expiration date on it, which means we do not know the day we're going to pass. So if I have $30,000 here and I have a life insurance policy of $500,000, if I drop dead yesterday, because I don't want to use the future, yesterday you died, your family gets immediately $500,000. That's awesome. But in the meantime, as I continue to save this money and continue to build it, the longer I keep the money growing, the better. Look at that. In 42 years, that's $586,000. In 30 years, that's $195,000, $300,000 saved. Even if you don't have a balance, let's say you didn't have 30 G's and you just did that. In 30 years, just $200 a month, that's $166,000 balance that you have saved. Why give up your hard-earned money to the bank by making extra payments? See, so don't do that if you don't have to. You don't need to. The banks don't want your money that badly. I mean, of course, the banks need it from you. They want you to give it to them. You need your money more than giving it to the bank. So keep your money working for you. Because at the end of the day, the only thing that changes is the payoff period. That's it. That's all that changed. It doesn't affect the total cost of the car. It's still $38,501. Interest lost by the bank because they didn't have to invest the money, $5,681 is what they lost. So opportunity cost, always remember that word. Now, another thing is, what if the financing rate is lower? Well, that's where if you have great credit, that's where you win. Because your great credit says, hey, you could negotiate the interest rate. You can get a better deal. So if it's a lower interest, that's even better. Guess what? You get to pay the lowest. So your goal is to find a bank. First of all, build your credit up, because credit is king, cash is king. Both of them combined, you're just winning all day long. Because now you could go in and negotiate and have a better opportunity to get a lower interest rate and then stretch it out. See, when I purchase stuff, especially cars, because cars don't have any value. I don't care about a car. I just need it to drive me from point A to point Z, right? So if that's all I need the car for, guess what I need to do? I'm not in a hurry to pay off that car. I need to stretch it out for the longest term. Why? So I could have a lower payment, so I could continue to build my wealth. That's the key. And use this money here for opportunity. See, we forget that opportunities, when they present themselves, they need you to have money. Because you could have the best business idea in the world, but if you don't have money to fund a business, you lose. You can't do it. So what if you could have your money here, an opportunity comes that says, hey, you know what? If you take money out of this account and invest it with me for some, let's say there's an opportunity, maybe a real estate deal. One of your neighbors they went into foreclosure, who knows, right? Or they didn't pay their tax bill, and the tax bill is $20,000. And you happen to be having a conversation with him. He's like, man, I can't pay my bill, my taxes. They're going to take this house because the government's going to take the house. It's what they do if you don't pay the taxes on it. What if you work out a deal with your neighbor and you already figured out that, okay, all he needs is 20 grand to save his house, and this house is already paid off. There's equity sitting in there. He can't even refinance because his credit is jacked up. Guess what you do? You say, hey, listen, why don't we work a deal? I'll get on the ownership, the title of the house. I'll become the owner of the house. I'll use your house as collateral, and I own a piece of the equity. You agree? He says, yeah, I agree. I need 20 G's. I don't want the money to go to the government. And you can continue staying in the house if you really want to stay in the house. Yeah, sure. You take 20 G's out of here. Now you worked out a deal with them. Maybe your agreement was you make 30 G's on top of it. That's an additional $30,000. I'm just throwing out ideas. Why would it work? Because you have cash. The person that doesn't have the cash to make that deal happen wouldn't happen. Or you have a dream to start a business, and all you need to do is invest 20 G's or 100,000 or whatever the case might be. When you have the money in your account, it allows you to make wise investment decisions because you have the opportunity to make those things happen. The reason a lot of people cannot fulfill their dream of building wealth because they don't have the money to do it. They've given it all away in extra payment to the bank, or they pay cash for it. So let's look at that scenario. When somebody decides, you know what, I want to just go ahead and pay cash. This is what happens. What they do, they go into their safe tank and they drain the tank. They take all the money out. I want to pay cash, and they just pay cash. Now I'm going to start saving. But how many people do you know put the money back in with interest? They don't. They only put back what they took out of it. So they don't even put back the money with interest. So they only put back the principal, but not the interest. That's why the interest they would have made, they lost it. So they lost $8,501 because they didn't pay all the money back with interest. They just paid back the principal. So what I teach you to do, whenever you borrow money, this is what I do. Whenever I borrow money from my insurance policy, just to kind of make that picture come to life so you kind of see what I mean by that. So if I go into my insurance policy, first off, the first thing that happens is I have a death benefit just in case I don't make it home, right? My kids, my family, they don't have to stress, they don't have to suffer. The money is there to take care of any situation while my policy is still growing. Because when you start your life insurance policy, of course, there's no money in the first few years for you to access, depending on how the policy is designed. It has to be designed well. You're pumping money into that. So you're paying your premium. So you start off the first few months, it's taking time. Now it starts building. Now it's building. So guess what? Now the insurance company becomes your bank. You want to go buy a car. The car costs $20,000. You have $30,000 in your account. You go to the insurance company, and this time what they do, they say, you know what? We're going to loan you the money. So they loan you the money to buy the car. Now you treat that loan as if you took the money from your traditional bank, and guess what you start doing? You start paying back the insurance company. As you're paying back the insurance company, now here's the deal. The insurance company does not report you to the credit bureau. They do not. So what I did when I was building my credit is this. I'll go to a traditional bank, borrow the money so they could report my information to the credit bureau that I just borrowed $30,000 from them. So this is how that looks. This is what normally happens. So you go to your traditional bank and they use my income as collateral and they loan me the money to buy this car. So as I continue to, in the meantime, I'm building my cash value life insurance. I was building it, saving it. And then as soon as I have the money, because I'm also paying down this loan from the bank. But then as soon as I build up enough money in my cash value, the next thing I do is I just switch the loan over to the insurance company. So I take the loan from the traditional bank. Now I did a balance transfer. You have heard that before, right? You transfer the balance from one bank to another bank. So what I did, I transferred the bank from the loan from using my income as collateral, and I transferred it to the insurance company. Now the insurance company says, okay, we're going to use your cash value and your death benefit as collateral. And I start paying back the insurance company, paying them down. While this is still growing, I never touched my money. I'm using the insurance company money. Now this is done. Now when this deal is done, guess what happens? This money that used to go to the insurance company, because now the insurance company cannot accept the money, guess what I start doing? I could increase my policy and start dumping the money in here. Because I'm already used to paying this money. If you're already used to making this payment, then you need to continue treating it as if you're still making the payment. See, the key to wealth building is always have your money working. Always treat every dollar you're spending as if you're still spending that dollar. What do you mean by that? If I borrowed money from somebody and I'm paying them back, and I've been paying them back for the last 3 years, and I only have 1 more year to pay them off, and I'm done with that payment, right? Well, once I'm done with that payment, the next month, I continue contributing that payment into my savings account. In this case, my casual life insurance policy, it starts going in that account. And I still earmark that money to say, hey, I'm still paying the car note. I'm still paying for this car. I'm not done paying. I still owe this money. This money is still going to us, but it's not going to a bank. It's going back into my own policy to do what? So the policy continue to grow and build more equity for more opportunities later. And guess what I could also do? If I don't want to put it in this policy, if I don't have room to do it in here, then guess what I do? I set up another policy. Then I take that 566, I start putting it into another policy and let that policy build wealth for me. That's the way you do it. The life insurance policy is not an investment. It's a place to park money. It's a garage to park money. And this garage is safe and it's protected. No one can come in and take the money. It's a private contract between you and the insurance company. That's it. It's a private contract. That means no one can subpoena the life insurance company to release any information about your particular policy. See, they could subpoena the bank. They could subpoena all these other, they can't subpoena the insurance. It's a private contract. See, a lot of people don't even know that. It's a private contract. And then if you really want to go gangster with it, guess what? You could change the owner. You could move the ownership from you to either a trust, and they have numbers of trusts we could use, or even to somebody that you respect and you trust self. Maybe your parents, your mom, your dad, they could be the owner of the policy for you, and you funding the money in there. It's up to you. But that's a different conversation, different ways to protect your hard-earned money. And one of the greatest things about insurance is the fact that it doesn't go through probate court. It does not show up in probate court ever, 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 ever. Whoever you choose as your beneficiary is the person that's going to receive all this money. And when they receive it, guess what? It's tax-free. Tax-free. I know we don't have a lot of time to continue, to have this conversation. That's why it's so important to continue doing your research, check out information. I wrote a great book called Creating Generational Wealth, has tons of information in it that will help you scale a little. And then got tons of videos on YouTube that could help you understand. And there's tons of other folks that have written books about it. But listen, folks, at the end of the day, it's my opinion. I've used it. It's working for me. What you should do is weigh your options, research everything you do, check out, go see, look at different options, write down the benefits, the key points, write down the disadvantages on everything you invest money in, everything, and then figure out which one makes sense. The key thing you gotta always remember when you're putting money anywhere, because remember, it's your hard-earned money. When you're putting this money somewhere, how quickly can I access the money? That's the first question. Is it liquid? Can I get money when I need it? Second thing you're going to look for is the money, the interest rate I'm earning on the money. Do I have to pay taxes on that money? Right? So when I earn interest, am I paying taxes on the growth? If you have to pay taxes on the growth, imagine how much you're losing on that. That means every time you make you put in let's say you have $1,000 in an account and you make $200 in interest, and then you have to pay taxes on that $200. That means, let's say the taxes was $50, just using that number. So now you really made $150 because the IRS took $50. So now $1,150 is what's compounding instead of $1,200. So you lost interest, but most will never look at that. So I want my money to grow interest in an account where the government doesn't tax the interest rate on my money. And then the next question is there any penalty when I want to take the money out? Are they going to hit me with a tax penalty? That's another question. Well, with life insurance, there's no tax penalty because the way you access money from your life insurance is in the form of a loan. There's two ways you could take money out. You could do a loan or you could do a withdrawal. You do it in form of a loan. Why a loan? Why would I want to loan money? Why not? You're borrowing money from everybody else. Ain't you borrowing money for your house? Yeah, I borrow money to buy a house. Ain't you borrowing money from the bank, the same bank that's holding your money, paying you 0.1% interest rate? You're happy to go to them and borrow money, and they're charging you 18% on credit card, but you're pissed off to borrow money from an insurance company because some financial person that you saw on TV said, oh, it's not a good idea to put money in an insurance policy. Why should you borrow money from there? But that same financial person says, hey, go to the bank and get a loan from the bank, or put your emergency money in your savings account at a bank where the bank is giving you 0.25%, but you never question them and say, well, if the bank is only paying me 0.25% interest rate on my money, over 30 years, I put $200, which is $72,000. I only made $2,761 in 30 years, and you keep telling me to put my emergency money in the bank. Why should I keep putting my emergency money in a bank account and the bank disrespect me with, first of all, with the interest rate they're giving me? Second, they take my money and they loan it back to me and charge me a high interest rate. That's crazy. So, Deborah.
Yeah. That's what I'm talking about. If y'all don't feel like that, yeah. Wow. Yes, indeed. Yes, indeed. And this is just the tip of the iceberg, just the tip. You have to get his book. You have to get his book. It's on the website at thewinnersummit.com. He's on Amazon. You can go to his website and get it. You have to get this information. Stop it. What's the song? I don't know it, but I heard it's a song. Cut it. You need to cut it. You need to cut it. If you still listening to these people, it's not designed for the masses. Do you want to stay with the masses, or you want to be a leader? You want to be out front. You want to protect your family. You want to have resources. So, man, thank you so much, Douglas, for your time today. You could tell his passion. This is not one thing, you know, like I said earlier, is that there's a common theme that you'll see woven throughout today. And you can tell every person that's speaking is passionate about what they're talking about. It means they love what they do. That means that they found their purpose. Like Sharon said, I know this is what I'm supposed to be doing. So I hope today is helping you carve that out. What is it that you should be doing? Because if what you're doing is not making you speak with fervor, like Douglas just spoke with, you really need to really realize that we're not supposed to just be here collecting a check every day, just going doing something just because that's what we do. No, we need to be doing something with purpose. And so, Douglas, thank you again so much. I am excited every time I hear you. I mean, I'm like, oh, I'm just ready, ready to continue to move on in my life, but to continue for the world to get this info that's been hidden from us. So go to thewinnersummit.com, get this information. Douglas, thank you again. Continue to have the most enjoyable day. Father's Day, happy Father's Day, joining us.
Thank you.
He don't mind hanging out with us here. All these women over here with the Wealthy Sisters and at the Winter Summit. He's definitely been a solid partner and staple in the platform that we have here. So again, enjoy your lovely babies on Father's Day. And we most know that people will be reaching out to you. They need to contact you. You need to ask him. They say, man, tell me that again. You need to get it. Don't ask the banker. They don't have this info. I don't care if they have 5 degrees with an MBA stacked with Z's degrees. Don't do it. Contact Douglas for sure, so that he could put you and your family on the right path. Thank you so much. We're going to now move into, this is a perfect segue, and yes, it was intentional to do this, a perfect segue into what the next subject is. And let me make sure that I stop the recording.